Welcome to the Link edition this week, and we thank you very much, viewers, for keeping with us. We promise you we'll keep on bringing you information that you can use. This is a tough economic time. Last week we featured the exchange rate, and we continue to discuss economics, policy decisions that you don't know that may affect you. And today we are discussing the central bank rate. It is a number that the central bank gives to the market, to the financial market. And the financial market uses that number to make decisions that may affect you. However, I'm not the expert tonight. In the studio, I have Mr. Jimmy Apaa, who is the Director of Research, Bank of Uganda. Mr. Apaa, welcome.
Thank you, Simon, and thank you, listeners.
Okay. Now, I think it was last week, the central bank changed this animal called the central bank rate. Normally, you used to do it every 2 months. But now, we are seeing you doing it monthly. What is going on?
Thank you, Simon. As you said in the introduction, we are living in an abnormal time.
Absolutely.
We are faced with the supply side driven inflationary pressures, which is coming from outside Uganda. But we have also seen food crops prices, which are domestically produced, starting to increase because of the impact of the recent dry weather conditions.
Yes.
And so the management of Bank of Uganda decided that they should meet regularly because we are facing a tough time, and monitor these conditions and take proactive and timely action as required. And that is why we had to move from the bi-monthly meetings to monthly meetings so that we can make proactive decisions.
Okay.
Yeah.
Very interesting. So now the central bank, you raised it to 9% now. Some people are wondering, so there's a press conference, Bank of Uganda says 9%. What does that number have to do with me? Bring it down to me.
Okay. The central bank rate is an interest rate that commercial banks use to borrow from Bank of Uganda. And then using that rate, they would then price their assets, their lending or other assets using the central bank rate.
Okay.
And so it affects what we call asset prices.
Okay.
Asset prices are like the exchange rate, like the credit interest rate.
Yes, the money I borrow from the bank.
The money you borrow from the bank. And if you go for a mortgage, the interest you pay on your mortgage. Yeah. So what it means for you is that raising the rate means that you are going to face a more appreciated exchange rate. What that means is that the prices of imported goods in the country are going to be low.
Okay.
And so that will feed through to other prices, and so inflation will come down.
Okay.
What it means also is that we are trying to motivate you to save than to borrow. Yeah, we are discouraging you from borrowing.
Say that again.
We are trying to encourage you to save more than you borrow.
Okay.
Yeah. Because if you save at a higher rate, you earn more returns than just spending or borrowing to spend. So that is, it is like a motivation for the households and farms to put their money in the commercial banks to save.
Okay.
And discourage them from borrowing.
Now, you're saying discourage me from borrowing. I do know that when you raise the central bank rate, and you said that earlier, the amount of interest rates I pay to the bank on my loan increases. Isn't that counter to my business growth, for instance? People want to understand. I want to grow business, but central bank is telling banks increase interest rates. Isn't that counter?
It is some sort of counter, but if you look at higher prices, higher prices tend to affect activity more than the increase in the lending rate.
Okay.
Because first of all, it erodes your income. You go to the supermarket with the 50,000
and you buy less.
You buy less than what you used to buy. If you used to buy 2 buveras of commodities, of goods, now you may only buy one vuvera of goods. And that discourages consumption. It also affects your confidence. Okay? If you know that prices are going to keep rising.
That's the mindset I'm having.
The mindset. Definitely you will be timid. You'll be timid. You don't want to spend as much as possible. If you want to drive across the town, across the city to check on your friends, you have to think twice, because you are going to spend more money on fuel.
Okay.
And that is bad for growth. So it's better to first fight inflation and then start to see growth picking up after inflation has subsided.
Okay.
Yeah.
And let's then connect to that key question.
Yeah.
If oil prices and imported goods are the ones which are causing problems because of Ukraine fighting and other factors outside there, really, for me, it's not my fault. And yet, you are now, central bank takes action to limit the amount of money I can spend or the amount of money in my pocket. Yeah? Why are you attacking on my pocket instead of trying to help me solve the problem of having imported inflation which is high?
Yeah. I would liken your question to this head of a household who has seen a snake entering the house. And you say, I don't know where this snake is coming from. So I'm not going to do anything about it. It is dangerous. You are not going to sleep because there's a snake in the house. You are not going to do any activity because you fear the snake might know where you are. And that is very dangerous. So what happens in the monetary policy is that we know that these causes of inflation are from outside Uganda.
Absolutely.
But if they are going to be temporary, then we would not do anything about it, because it would die by itself and things would pick up. This is initially what we thought. But that was in April. In March, in April, we thought this was going to be short-lived. But we started to see other components of inflation starting to rise, which are not affected directly by oil prices, like transportation, like hotels and restaurants. The food in the hotels and restaurants have started to pick up. And that is a concern. So if you do nothing, higher inflation get entrenched. Workers are going to start asking for higher wages. Maybe schools are going to raise school fees. Everybody will plan with higher prices.
Everything is going to go rise.
And so that higher inflation starts to cause higher inflation. And you end up in an inflation spiral, what economists call spiral. So that will definitely cause more problems to economic activity than just the tightening of the raising of the central bank rate. So it's better the central bank fights this animal called inflation so that it doesn't become entrenched. Let's go back to the teach me again. In order to fight what you call inflation getting entrenched, people thinking, things are just going to go up. Everybody thinking things are going to go up. Bring me back again. So when you raise the central bank rate, how does it help stop that tendency of thinking things are going to get worse and worse and worse? How does it connect the dots for me? Okay, let me connect the dots. So the first thing, there are different channels through which the raising of the central bank rate will lead to the reduction in inflation. The first one is the exchange rate. So when you raise the interest rate domestically, you make the returns on assets denominated in Uganda shillings higher than the assets denominated in foreign currency. In other words, people will want to invest here in Uganda than invest abroad. And so bringing money to Uganda, you'll have more dollars in the economy, and so that will help reduce the price of the dollar. Because now you have more dollars in supply. And that has happened. If you look at what happened in June, there was massive depreciation in May and in June. When the central bank raised the rate in June, we have so far seen an appreciation, by the way. The dollar was almost hitting 9,000. Right now we are on 3,700.
Yeah, it was going 39, almost 4,000.
So you could say that it is now working. Secondly, when you raise the interest rates, banks are going to tighten their lending conditions.
Okay.
Even without increasing the rates.
They are going to lend less.
They are going to be cautious on lending. They are going to say, maybe these guys who want to borrow on higher rates are bad borrowers. Because a good borrower will want a lower rate.
Yeah.
Yeah. So they are going to tighten conditions. If you want a loan, you have to do this, you have to do this, you have to do this. In the end, they are lending lower.
Okay.
And that will feed through to consumption and investment, and demand is going to be lower than supply.
Because people don't, there's not enough money going around.
Yes, the money is little in the economy, and that will help check demand as supply adjusts to help prices come down.
Okay.
Okay? That is one. That is the second one.
Yeah.
Now, the third one is just raising the lending rate.
Okay.
When the central bank raises the lending rates, commercial banks are going to adjust their lending rates upwards. And that discourages you and me
from borrowing.
The only people who will want to borrow are going to borrow are risky borrowers, I mean. These are guys who don't care.
Yeah.
They can even go and borrow from the money lenders. They don't care. They just borrow. And they are going to default.
And those are few.
They are very few. Now, the other thing that is very difficult to measure is what we call expectations. That I told you that because prices are rising, everybody else will want to increase prices.
Yes.
Even when you are planning for next year, you are going to plan with higher prices.
Yeah.
And that will keep inflation entrenched. That is what we call the expectations channel. Okay? So by raising the rate, we are trying to manage expectations.
Again, money, not enough money just jumping around.
Yes, yes, yes. We are managing your thinking. Because if you look at 2011, 2012, when inflation shot to double digits, and the central bank raised rates up to 23%.
I remember,
Credit demand came down significantly, and inflation came down back to single digits.
Yeah.
And with that track record, we want people to believe that when we raise the rates, we mean it. We are going to bring inflation back to 5%, so that when they are planning for the future, they should plan with 5%, not anything more than 5%.
All right.
Yeah.
Thank you very much, Mr. Jimmy Apaa, for bringing out the technical subject.
Yes.
To as low as we can bring it.
Yeah.
Viewers, when you hear the central bank rate, don't say, those people's things. It comes down to you somehow. And if prices, general prices of goods and services in the economy are arrested, that means you're not going to buy less with your money in the next 6 months or 12 months. That's what the central bank takes the action to make sure the money you have continues to have value. We hoped we added value to you, and we hoped you learned something. If you missed this and you want to go back, this video will be on YouTube after you see it today. You can go back on YouTube and you will go back slowly and be taught. That was the link. Thank you for joining us tonight.